Harish Krishnan is here with us to talk more about markets and macros. Harish, of course, works with Kotak AMC. Harish, afternoon, and thank you so much for chatting with us. Let me start with the macro view because Fed meet the expectations are pretty rife of one more rate hike over there. But then the kind of opinion is divided whether this will be the last hike or a prolonged pause and then rate cut cycle. Which way things likely to pan out over there, because it will impact flows to emerging markets, though the way it has been in the last few months.
Oh, hi Ajay, good to connect as always. So yes, you're right. There is a divided camp in terms of what the prognosis post the next rate hike is likely to be. And while there are merits in both camps, I still think that the Federal Reserve will look at the stability of the system rather than only inflation at this point of time. Inflation seems to be reasonably controlled and is not anchored at very high levels in US. And so while it's still away from its glide path, and therefore one can still argue that the rate cuts are going to take some more time before they start coming through, I would be kind of surprised if they continue with the sledgehammer post this one rate hike to keep continuing to focus on inflation. Do also keep in mind that there is an election around the corner there as well, which means that they wouldn't want to significantly upset any apple cart out there. Growth and stability, which have surprisingly been very positive and continue to hold strong, I think will be far more paramount than just necessarily taming inflation, is my view.
Harish, what are your thoughts on something which is not, very widely being discussed right now? And that is, are there any risks on the global horizon? Risks, which may actually derail this risk-on kind of an environment. The rate cut expectation that rate cuts are around the horizon 6 months far out, and hence the risky asset class are rallying. But is there risk also lurking below the surface, be it on the credit side or commercial real estate in US or somewhere in China, which perhaps everybody is missing out on?
So China is clearly, a can full of surprises, and pretty much while the demographic issues out in China are very well known, I think at every point in time there is this lurking fear that there is too much of leverage, especially on the real estate side. On US specifically, of course, we do keep reading about issues with their commercial real estate, especially the huge amount of tenancy vacancies that we are seeing in downtown major urban centers, including New York, San Francisco, etc. That does seem to convey that there is a risk which is not necessarily being carried by the banking system, but by the shadow banks, by the funds, by the real estate investment trust, etc. Which potentially one needs to take a real caustic view in terms of marking to market. But I would say that the risk from an Indian context, I would say, is more from a function that today volatility is extremely low. So, and I'm not necessarily referring to the VIX measure, etc., that people talk about. If I look at, say, the currency, the Indian rupee has been in a very tight band. It's been the lowest band that I have seen for the last almost say 15, 20 years. We've never seen such a tight band. And mind you, this is happening in a time wherein, for example, the dollar index itself has given up a significant amount of a move. The Japanese yen has given a significant move. And therefore, it is kind of quite amazing to see the very tight range that the Indian rupee is currently being at. Similarly, the volatility in the Indian bonds has been extremely low. So my belief that volatility is a coil spring. The longer you try to suppress it, it tries to come out in some form and shape. And I would think that is one risk that people have to be more cognizant about. Especially those who are on the trading on the import-export side, that one shouldn't get complacent with such low volatility that they are seeing today in various asset classes.
Is there valuation risk as well, or valuations are getting support from liquidity and the earnings quality also, at least the kind of earnings which have been reported so far? Are you comfortable on that angle?
So Ajay, obviously, when we look at valuation, there is a near-term headline valuation in terms of say price to earnings, etc. But if we were to take a slightly more, 30,000 feet kind of a view, and were to look at say market cap share, India's market cap share as a percentage of the overall world market cap is roughly about 3.3, 3.4%. India's GDP share as a percentage of the overall world GDP is again at 3.3, 3.4%. In an environment where, it's reasonably quite clear that India is going to be the one that is going to lead growth globally, whatever be that extent of growth can be debated. But compared to most other economies which are challenged on demographics, which are challenged with very high debt, we seem to have a better line of sight in both of these two key macro variables. And therefore, should we call out valuation when broadly we are at the same share of GDP as our market cap share? I'm not so sure that should be the key point. The second point, of course, is that for a foreigner, the Indian equity markets are still about 7-8% lower from their highs that they have seen in 2021, courtesy the fall in the Indian rupee. And therefore, it is more important for them to gauge whether the Indian rupee itself is going to continue on its significant depreciating bias, or whether it's going to be more stable or possibly even start seeing some amount of appreciation. And I guess it is that that is causing the flows to come in, even though as local participants, we keep talking about all-time highs, etc. For a foreign investor, they still are getting a reasonably better entry price from a dollar point of view. And therefore, I guess that's going to continue. The negative, of course, is that there is significant amount of supply that's starting to come through. Be it that of private equity, venture cap, promoters, and that I would imagine, at some point is going to cap the significant amount and, absorb a lot of these flows that are going to come through.
Which part of the market, Harish, in your view, is the best risk reward right now? Because though we may say headline index is just come out of new territory and scaled the previous high, but fact of the matter is from the lower levels, banking has run up quite a lot, defense has run up. You talk about the sector and it has run up quite a lot. So it is difficult to really pinpoint areas which have not participated. Where do you see, where you're seeing earnings growth also in the same proportion as the run-up, making the investment argument still compelling? Where have you been adding in the last 2-3 months?
So I think we take a slightly more longer term view, Ajay. From that perspective, if we broadly divide the bucket into say four, which is consumption, investment, then you've got export, and then you've got financials. These are the broad four large thematic buckets that one thinks of when investing in India. I would say investment holds the maximum near-term visibility in terms of earnings, but it has also done extremely well in the last 2-3 years, right? Consumption has had its moments, but it's had a roaring rally over the last 10 years pre-COVID. And a lot of portfolios are still geared towards consumption. And I would say that that is where I would be most watchful of. The consumption theme, to my mind, is not as strong as what various investors continue to believe, despite the promise of a very young population and rising per capita, etc. I think we are kind of stuttering as far as consumption is concerned. Where the maximum risk reward, because that's a question that you seem to have asked, is more on the export side. Because there clearly people are worried about the near term, which is that a recession is coming. And like I keep saying, this is possibly the most well advertised recession in the making. Almost for 18 months, people have been waiting and watching out and calling out that a recession is around the corner, which means that a lot of thinking and a lot of planning by various corporates in the developed world has already been conditioned by the fact that there is a recession around the corner. So when it actually happens, and in case it is a shallow recession, which is the base case for us, I think India's competitiveness in the export market is bound to rise, and we are likely to gain meaningful share as well as meaningful revenues on that. And over there, it could be, of course, the IT services, the pharmaceuticals, the auto ancillaries, chemicals. There are a whole range of manufacturing and services out there where we think that the risk reward is much better. Financials, again, the near term is all great. We've had blowout numbers. There has been some amount of margin compression, but I would reckon that the best of numbers is behind us. And at the margin, we'll start seeing some softening. So this is broadly our thinking at this point of time from a 3-year out perspective.
Excellent point. Exporting companies on the fear of recession, if they've got sold down, that is an area you should be researching on. Harish, great to chat with you. Thank you so much for your time.